Join audio call. I got the permission.
Yeah. So yeah, let's start with why the 2008 financial crisis really happened, and very briefly, what could have been done to really prevent that on a smaller scale, but also about what were the long-term causes of this, and these are the causes which are also likely to cause another financial crisis sometime in the future. And that is something that I'll try and establish in this short session. I think what will also be useful is your pre-existing knowledge. For the same reason, I shared a couple of documentaries which I recommended that you guys read, go through. And if you've gone through those documentaries, I think this workshop will be capable. Okay. So I think a lot of you will now be familiar with the broad classical economic theory, which is to say that people think about classical economics in which people broadly think about their own self-interest. And if there are corporations who are thinking about their self-interest, it means that people would be able, okay, just one second. It means that the companies would be in best position to determine what is in the best interest of the public at large and what is really good for them. But secondly, I think companies are able to think about their own interest means that they will struggle to remain profitable at various instances. So the idea that companies think about themselves at all points in time. Okay, these chats are incredibly distracting. Just one sec. Yeah. Okay. Oh, sorry guys, I had to block the chats. They were really distracting. If you have any queries, just use the main group because I'm pretty sure there'll be some spammers as well. Now, I suggest that we start from where we left off, right? Okay. So first, why was the 2008 financial crisis caused? I think the root cause was very obvious. That is, a lot of people were given loans for buying real estate, which is things like housing, except that they were not able to repay those loans. And because there were these kinds of loans were widely available across a large number of banks, so the banks were full of these kinds of bad loans. They were misrated by the credit rating agencies in many instances, and at some point in time people realized that these bonds or these loans cannot be returned, which means that they are essentially worthless. So these are called subprime mortgages because these were not extremely credible people to be issued loans to, and for the same reason they were not able to return these loans, and as a result a lot of banks ended up losing a large amount of money in all of these bonds which they had issued to a lot of people on the ground. Oh, now the simple question here is one, why did the banks issue debt to people who are otherwise incapable of paying it back? And why did they not think about their self interest in a manner that a typical free market economics generally predicts the people to be able to do? It's also about whether the government's subsequent actions, for example, things like bailouts, were legitimate. And fourthly, is the government to a certain extent responsible for the bad behavior on part of the banks? So I think these are the few questions that default on the part of the subprime mortgage credits generally tends to pose. So we'll try and answer these questions throughout this workshop. But yeah, this is broadly why the 2008 crisis was caused, because there was a default on the part of the subprime mortgage buyers, and sorry, or rather the people who were issued the loan through the subprime mortgages, and they were not able to repay that money back. So if you have any questions on this very small part of it, just feel free to post on the WhatsApp group. In the meantime, let's talk about a few factors or concepts which are particularly relevant to this small discussion that we have. The first is credit and why credit is particularly important. So, yeah, please elaborate. Yeah. Okay, so why credit is particularly important? Credit is essentially promise that I'm going to pay back a certain amount of money to someone else, which was issued to me before this. So, for example, if I give you, say, 100 rupees and you promise to pay it back, then I'm effectively your creditor and you owe me a certain amount in debt. So, that's how credit really works. However, particularly in the concept of banks, banks don't really need to issue a certain amount of money to the people. What does that mean? It means that when I borrow a loan from the bank, the loan that the bank gives me is not necessarily the entire amount that the bank actually has. So generally what banks do is they issue more loans than the money which is actually present inside. Why is that so? Because eventually the money which I'm going to, or the way in which I'm really going to spend that money is I'm going to give it to some other people through bank transactions, which means that the money is effectively just a number which is going to be transferred to some other person. And this kind of nature that money really has means that banks can create credit out of thin air. Why? Because not all the people are going to run back to the bank asking for money from it all at once, or that's what the bank assumes. To that extent, credit is what the bank issues and is what people owe after it is issued to them. So that's basically what credit is about. Now, why is credit important in particular? Because if you think about it, in any economy, if all the people earn their wages and they spend the exact same money to buy goods and services, then at best, all the companies will break even, which means that all the money which I'm paying as salaries to my employees is what the entire business class is going to get back eventually. If money circulates like this, then no business should truly be profitable. Because for a business to be profitable, they have to end up earning more than what they're spending. But they can only earn as much as the consumer spends. And if the consumer can only spend as much as they earn, in that case, no economy should truly grow. In fact, if people end up saving the money, then the economy should ideally shrink. So, what this means is that there is, and still we know for a fact that like all economies across the world are growing. So, that begs a very simple question that how do economies grow if people are, if there's a fixed quantity of money inside any economy, which is circulated in a circular fashion? The simple answer to that is that in addition to money, you have credit in the economy. So the commercial bank promises people to that they will be paying certain amount to the people in cash in the event that they come to the bank and ask for it. So your savings accounts is effectively the number shown in a savings account is basically a number that the bank promises it is capable of giving. Is a number that the bank promises that it is capable of giving, and this number is something that you can go ahead and withdraw. However, the total promise that the bank makes to all their savings account holders is generally a lot more as compared to the money that the bank actually has. And the reason behind that is that the bank issues credit without having any money to really promise that behind or to back it up with. However, why am I still able to get all the money back when I go to my local bank and withdraw the cash? It's simply because it has enough money to cater to the number of people withdrawing at any given time, but not all of them at once. which means that the bank is creating artificially some amount of money which only exists as numbers in your bank account. This is called the commercial bank money. And this commercial bank money is basically credit created out of thin air. And banks are capable of doing that. So, any questions particularly on credit? Yeah. So, can you explain why banks lend more money than they have, please? It's very simple. The business model of the banks is as follows. The bank really has to pay a certain amount of money to the people who have an account only if the people are withdrawing that amount from the bank, which means that the bank doesn't have to pay all the people all at once. However, if I'm able to put a number into somebody's bank account and I'm confident that that person is not going to withdraw all of that in the form of cash overnight, I know that there is some number created which will make the other person richer without really making me pay for it from the money that I already have. And that is how credit is really created. And commercial banks create credit all the time. So it's a lot more complex than the model which was probably taught to you prior to this when you were learning banking. But it is also the most realistic model for any economy to grow. For example, 97% of all the money in the United Kingdom is created by the commercial bank. Only 3% is real cash. And this has always been the case. So in United Kingdom itself, in the 1980s, the percentage was 12%. Today it's down to 3%. But broadly, this is the case. So generally, the debt issued is more than the cash which is available. And the reason why that's important is because that's the only way that any economy can really grow. In growing economies, you have more credit. In shrinking economies, you effectively have credit disappearing. And that also explains why financial crisis really becomes this big. Because when a lot of people cannot pay back the credit just the way was created out of thin air also starts disappearing into thin air. Because if I can't pay the money back, then the number does not exist inside the bank and the GDP starts to shrink. Why do banks do that? I think the model is very simple. If I provide a number to some person and that person is willing to provide me with actual money in return as a result of their business activities and the assurance that these numbers exist, then I'm able to make profit out of money that I don't even have using the backing of the money which I already have. So that's broadly why commercial banks do that. It's a very profitable business model. I'll just see if there are any further questions. In the digital era, having digits in digital account is literally. Today my question is, isn't this like building castles in the air? Won't all of this come crashing down one day? Oh, no. So it's not necessary that it comes crashing down one day, because so long as the economy is growing, people will continue borrowing more, which means that it will only come crashing down if someday people decide that they don't want to borrow any money any further. And in the absence of that, there is no such problem which is created. So long as the economy is expanding, the credit continues to grow. It never crashes. And that's basically what the debt cycle is about. And generally, like, the amount of credit in the world is 10, 20 times more than the amount of actual money which is present, which is both scary and fun at the same time. Yeah. Any further questions? So of course, government tries to regulate these things by stipulating a certain percentage of money that you have to have as compared to the debt which you're given. So say you should have access to say 15% of the total money which you're giving in loans to other people. I think that ensures generally that uh, there's some stability in this market and banks don't just artificially create arbitrary amount of commercial bank currency. So that's broadly there. Okay, so I think credit being sorted, I think you have a fair idea of what credit looks like. Credit is basically the money I borrow. Now, now I think we can start with two structural problems which I'm going to deal with in the entire session. One is the expansion of credit, and the second is uh, government sponsored institutions. So let's start first with the 1920s and why the current credit system, the way it is, came about. Because the history of providing finances to people who are worse off dates back all the way to the 1920s. So in the 1920s or even prior to that, people wanted to expand the access of credit to the people at the bottom. And the reason behind that is there was startling inequality. People needed more money to borrow, etc., etc. As a result of which, people were given access to credit at an easier rate by the central governments. And we'll come to that as to why that is going to go ahead and happen. However, let's start with the period before the government started regulating these things. So initially, the government had no regulation over how banks should be operating and how consumers should be treated. So the general norm was that the money lenders get to decide that. And that often led to the money lenders charging arbitrarily high interest rates. And there was some need to protect the consumers at that stage. When the 1930s Great Depression came about, a large number of people were unable to pay the money back to the money lenders, and the government had to go ahead and step in to prevent these kinds of defaults and to make the entire process less painstaking. Or to make this process less painstaking, what the government finally did is the government decided to buy all the debt that the people were not able to repay, restructure that debt, and expect people to pay it over a period of 20 years, 20, 30 years, as opposed to just paying it in the short term. This decreased the burden on the people themselves, made it a lot easier for the people to pay it back. This was done by a government backed corporation, and this corporation is today known as Fannie Mae. So Fannie was initially, it wasn't called that, it was definitely called something else, but it was first in the public sector, which means the government owned it, and the aim of that was to continue to dissipate the credit burden on the people, and that's something that the bank did successfully. And this continued to be done until around 1960s, where the people's access to credit had to be eased to a certain extent, and because this model was fairly successful. So that's there. Um, right now, we will not focus on the depression itself because that's a very different topic and that will really stretch this workshop significantly. But we'll just focus on the 2008 recession right now. So what is important here is how why Fannie Mae was really created. And I think it was definitely called something else. I don't quite recollect what it was called. So if you have any questions about Fannie Mae and making credit available to the people, feel free to ask here. Oh no, the job of Fannie was to just make sure that existing debt is something which gets restructured. So the government did not want to enter the debt business per se, but they knew that they can at least keep it in surplus for some time. Although eventually, when the interest rates continued to rise, the government decided to privatize it. So that's the second dimension to this. Now, that's about Fannie, the second institution, and Fannie generally did it by you going to large commercial banks and restructuring the debt that they had. So Fannie was generally there. Or the second institution is the Freddie Mac, which was responsible. It's again a private institution. Fannie was also privatized, but what was unique about Freddie is that Freddie Mac was responsible for restructuring debt from smaller lenders and smaller banks. So they are called thrift banks, and largely Fannie and Freddie are the two primary institutions that are responsible for restructuring the debt and also for issuing and also making credit accessible to the people on the ground. So this is the need to restructure this credit after the depression was the reason why these two institutions were established. Did Fannie Mae give out new credit? That is all. Okay. So here we'll not go into the intricacies of various recessions that existed in the middle, but we'll just look at how they really influenced the fault lines which eventually triggered the 2008 financial crisis. Now, coming to the income distribution in the United States. So now that I've spoken to you about these origins of Fannie and Freddie, or remember the problem with these two banks was twofold. I think one, while they were private institutions, they had tremendous amount of government influence over them. So the government oversight over these banks was to such an extent that it had a public sector interest as well in the manner in which it was established, and it also had private sector ownership in terms of taking decisions. So it was neither public sector, it was nor was it private sector. It was more like a government sponsored private sector bank. And the problem with an institution which is neither public nor private but has interest in both of them is that it mixes the corporate incentive of pursuing self-interest with the government interest of serving the society and making credit more accessible, or like serving society, which is the government's political interest. And mixing of these two interests can be incredibly dangerous, and that is something we'll talk about in the third part of this session. But now moving on to the second part of this workshop, which is the social divides that existed in the United States at that time. Now, the kind of social divides that existed were broadly economic in nature. So you had the immigrants who were relatively new, generally doing work which was not to be taken by the people who were already there. And second were like the people who were already there but economically backward, and also there were people who were the winners of that economic system. Now, American inequality is not a new phenomenon because inequality also existed in the 1860s, 1870s in the United States. And subsequently, it tanked gradually. So in 1900s, you had the Populist Party, which was interested in uh, making things in redistributive policies and in making like credit accessible to the public at large. So there were sufficient redistributive mechanisms which were established in the United States after the Great Recession or the Great Depression over a period of time. Now, before the Great Depression, these safety nets, etc., did not exist. But as you must have seen in documentaries as well, there was a need during the Roosevelt tenure to really address the pressing problem of how do I employ the people. So what the government did was they penetrated every aspect of people's lives to make sure that public jobs are secure. And in the process of keeping these jobs secure, they're also able to make sure that there's lack of instability, there's no instability inside the market, and that like the economy can be managed very effectively. Initially, this was fairly successful because the economy grew unhindered for almost 30 years. but that's also probably because they were destroyed to an extent during the World War that like they had to go and like recover and catch up. So we don't quite know what the cause of that is. But by 1960s, by 1970s, the economy started slowing down, or you had huge or great inflation. Now, what I'll try and do is show you what this inflation really looked like. So, just one sec, I'll switch the screen. Yeah. Okay. So this graph is basically inflation in the United States. Now I'll just move the cursor to various points. So in the year like in 1960s, as you can see, the inflation rate is around 1%. However, as the economic growth started slowing down, your inflation reached as high as 11% in the year 1974, which is because partly because of the oil embargo which the countries imposed on the United States. The Arab countries imposed on the United States during the Yom Kippur War. By the year 1980, the inflation had reached almost 13%, which is huge because this is the rate at which things around you are going to get increasingly expensive. So during this period, you had like a huge, this is known as the Great Inflation, effectively. Now, so that was the scale of the inflationary problem that the United States was facing. So at a certain point, the government decided that enough is enough. Instead of focusing on keeping people employed, we are going to focus on making sure that inflation is something which is under control. So what happened was that the government started targeting inflation as opposed to targeting unemployment. So what I'll try and search for is the unemployment data. So what you'll observe is that the period during which the inflation was really high, unemployment rate was fairly low. Okay, the data here is not available. So I'll take a look anyway. Uh, yeah, so the data is not particularly available. But yeah, broadly, if you just look at United Kingdom's data, also you will find the exact same trend. But I'll see if United Kingdom can be shown here somehow. No, even UK's data is not visible. But either ways, like I'll figure out where the unemployment data is. And what you'll observe simply is that the unemployment really shoots up during this period. But the inflation goes down at the same time. So you will observe that like there's a negative correlation. And so what was born were like two broad schools of thought. The left in the United States believed largely in big government, or they wanted things like redistribution of wealth, taxing the rich at a higher rate. And you had the right wing, which was broadly against redistribution, opposed to ideas which resembled socialism, and were broadly free market driven. And this kind of polarization is something that the United States always had. And while the center has shifted over time, these differences always existed. As a result of which, or coming to a consensus about what are the best policies is something that broadly remains absent. So I'll see if there are other versions of unemployment which can better correspond to this data. Just give me one sec. Yeah. So I'll try and show you this. So while you can see that from 1979, 1980, 1981, the unemployment rate starts going up, that is also the period where the inflation is dropping. So it's very clear where the government's priorities were. And after this point, the government's priority remained controlling inflation, even though the unemployment fluctuated rapidly. Now, so you have two broad opposing philosophies which were built in the political world at that time. And if you compromise on your philosophy, it's generally you become a target effectively for the other side. So that's one of the primary reasons why these kinds of political divides are generally not good. But there was another kind of divide which got exacerbated during this period, and I'll see if that data is also available. This divide was that of inequality. Now, the measure for inequality is the Gini coefficient. So I'll see if I can find inequality somewhere. Okay. So Gini coefficient, the higher it is, the more unequal the society is, measured by their wealth. So you can't see the graph here, so I'll just show you the data points. So in United States, in the 1970s, it was something like 34, and then you can see how steadily it goes on increasing. So the American society becomes increasingly unequal with time, and there's like a clear increasing trend, even though it fluctuates somewhere in the middle. Now, this increasing trend broadly started in the 1980s, where the society became increasingly uh, polarized in terms of rich and the poor. Now, in a polarized world where the inequality is really high, what you also observe here is that the inequality developed in a way that the wealthiest people's wealth really grew rapidly, but the poorer people generally did not see their income or their wealth grow. Yeah. So when people who were in the bottom half of the American society did not see their income growing, they were naturally dissatisfied with what is happening. Now, this dissatisfaction often translates into public raising outcry against the current government, and generally, the governments have an incentive to make sure that the people on the ground are really happy. So, in this case, the government had an equal incentive to make sure that these people are happy. But if you try for a redistributive policy, that probably will make the right wing unhappy. If you go for something which is in the form of giving tax cuts, etc., then that was clearly not very effective at that point in time. So we needed a solution which is like a compromise between these two and can also make the people on the ground happy. And I think these are the kind of circumstances under which the government decided that the best compromise solution for the people on the ground is to provide them with credit. Now, how does credit work, right? So, if my income is not increasing, but I still want to buy a house, if I start getting loans at a cheaper rate, I have greater ownership of homes, assets, cars, etc. And that was expected to keep people happy to a certain extent. And so if you look at, say, George Bush's agenda, or before that, Bush Senior's agenda, or Bill Clinton's agenda, or you'll observe that all of them, especially Clinton and Bush Jr., or prioritized home ownership and declared that to be one of the rights of the people. Now, was this like a perverse political incentive there, where credit to the people was to be given with the aim of as a soap in the absence of like their incomes rising, or was this a genuine intention that politicians had to make sure that their constituents are benefited, is up for debate. But either ways, it was a political decision taken out of political constraints that providing people at the bottom with cheap credit is something that should be done. Now, what this translated into is quotas being assigned to various banks to be lent to people who are economically poorer. So you had various acts for doing so. One of them was the Federal Housing Enterprise Safety and Soundness Act of 1992. The aim of these kinds of acts were broadly to mandate a certain quota of people to be able to be given access to cheap credit, and the government set the interest rates incredibly low, which meant that if I borrow the loan, I have to pay a very low interest rate to the bank as well. How does government do that is a very different question altogether, which we can go after. Maybe you can ask me privately. But generally, the central banks are able to set these interest rates, and they set the interest rates low, and the government mandated quotas to be given to the poorer people, which encouraged poorer people to take more loans so that they can build houses or own their own homes, and that was expected to keep people happy. Now, oh, if you observe the data, this is my reference for this one is Rajan's book, Fault Lines. The data for the poorer people in terms of the amount of mortgage that they have showed that there was an increase in the total amount of housing loans that people at the lower income bracket bought, whereas the people in the upper income bracket, the amount of housing loans that they took actually had a decreasing trend in the years leading up to the financial crisis. So it was clearly evident that there was government intervention in terms of policies targeted to the people who were really poor. Now, why did the commercial banks also enter this market? Because right now it was broadly directed by the government through Fannie and Freddie. Or the reason why it was directed, because the reason why the commercial banks also started towing this line was because of a precedent which was created. So now this is where I move on to the next part of my session. But before that, do you have any queries about how inequality led to credit being given to people who are otherwise not particularly capable of returning it, and why there was political incentive in terms of people having to compromise? Yeah, so no queries there. In which case, let's just talk about the third problem which eventually translated or which effectively broke the back of the economy. The third problem is banks assumed that in the event that the people are unable to pay back the loans, the government is going to use their tax money to pay the loan in place of all of these people. Why? Because of two reasons. One is that the purpose behind having easy credit giving to the people was primarily scoring those political points. So to that extent, people not being able to pay back that debt goes against the fundamental purpose of this policy to begin with. So that gave the banks a good amount of assurance. Or another reason why another reason why the banks did it was because governments had a history of bailing out big banks. So in the year 1984, uh, the American government bailed out Fannie and Freddie, which set a precedent for a series of bank bailouts throughout the 1990s. Uh, Similarly, when Mexico had a balance of payments crisis, the Bill Clinton government provided Mexico with uh, a bailout package, which enabled Mexico to eventually revive its own economy. Same happened when uh, there was a financial crisis in South Korea, again during the Clinton period. So all of these trends showed government's willingness to bail out institutions. And this kind of willingness created a precedent where the banks became incredibly confident that government is going to bail you out somehow. Now, in addition to this, what was also done was the government was extremely overconfident in their ability to solve a financial crisis without using taxpayer money through adjusting the interest rates. Because in 2003, there was another minor financial crisis that the United States had, and the government slashed the interest rates to make sure that the economy gets revived. So that set another precedent for the people to be able. That set another precedent that the government felt overconfident about interest rates being a way to really adjust like an economic slump. The way you do that is you lower the interest rate. If interest rates go down, more people want to go ahead and borrow debt. And if more people want to go ahead and borrow debt, then the economy will start growing again because credit is required for economic growth to happen. And that proved to be really effective in 2003. But in 2008, the interest rates were already so low that slashing it further really didn't help boost the economy back, which means that they had to resort to bailing out larger banks to prevent the crisis from spreading. So that's another reason why this happened. Now, so now let's look at the series of events that really played out and translated into the financial crisis and in turn the final recession. But before that, if you have any further questions, I'll address them. Yeah, okay. So no further questions. So I'll just move on to how the crisis finally played out. Now, government decides to provide cheap credit to people who are unhappy because of their stagnant wages. As a result, Fannie Mae and Freddie Mac both are pressurized by the United States government to issue debt or like restructure debt for like the poorer people. As a result, there was an opportunity which was opened by the people. An opportunity was opened where more and more people were issued debt. Or if the interest rates were so low, why did government realize they can't slash it further? Oh yeah, I'll come to that. Okay, so right now just let's just focus on the entire series of events that really took place, right? Oh, so first, the government issues cheap credit through Fannie and Freddie, and that goes to the people who are otherwise not capable of being able to pay back this debt. Why? Because the government wanted to appease a public which was otherwise unhappy by their stagnant wages. But redistributive policies could not be implemented because they were seen as socialist, and they had to come up with some form of political compromise, and credit becomes the easiest way of doing it. Secondly, the commercial banks jumped into this business as well, providing cheap credit to people simply because they saw that government will bail them out, given that they had precedents of governments also bailing other banks out, which means that there was a full scale issuance of credit to all of these people. Thirdly, while trying to come out of the 2003 financial crisis, the governments decided to slash the interest rates. So There was like steroids provided to the economy, and the interest rates were artificially low. So I'll see if I can show you how interest rates went about during this period. Okay, so this is lending rates, so which is more or less positively correlated with the interest rates. Now, this is during 1981. The interest rates were really high because inflation was very high. Inflation was high, so they had to decrease the amount of money available to the people, because if the amount of money decreases, then the value of the money goes up. And to decrease the amount of money, you raise the interest rate so that people borrow less. If they borrow less, there is less credit generated. Less credit means less money. Less money means deflation. As a result, there was this unprecedented interest rates of around 18-19% during the 1980s, after which the government has slashed interest rates repeatedly. Now, let's come to this period. So I'll just try and forward the timeline. Yeah. So this is from 1996 to 2018. Now, as you can see, during the financial crisis or in the 2000 and like in early 2000s, after the dot-com bubble was burst, the the commercial bank the central bank aggressively decreased the interest rates to a point where it was around 4.12%, and then they decided to start tightening it. However, as they went ahead to and they realized that the interest rates are incredibly low, but as they started tightening these interest rates, after realizing what their fault, by the time they actually brought the interest rates back to the pre-crisis levels. Okay, I think there's some ambiguity here, so I'll just clarify it clearly. When I'm sure this is the year 2000, which means that we are talking about the dot-com bubble and the crisis in the 2000 and the early 2000s, like 2003, etc. When the economy started sliding at that time, the interest rates were slashed to save the economy. However, once you pulled out of the financial crisis, you realized that your interest rates were incredibly low. So you started tightening it. But by the time you could actually tighten it and bring it back, this is the year 2007. So by the time you could actually tighten it and bring it back, the people had already bought real estate in large amounts because the debt was available to the people readily during the low interest rate period. After which, once the crisis struck, no matter how hard you try to slash your interest rates, it was absolutely ineffective simply because the investment in real estate was too much to be offset by this kind of interest rate cutting. Secondly, by this time, people had lost their faith in the banking system anyways. So there was no point of cutting the interest rates given that the banking system was all seen to have performed poorly. That being said, slashing of the interest rates turned out to be ineffective in the 2008 crisis simply because the banks themselves had failed in their fundamental obligation to stay profitable because the kind of debt that they took was not good. So that's basically there. Now, what that meant was that the banks had issued a certain amount, or rather, the bank had issued a certain kinds of loans which couldn't be paid back, which means that people did not trust the bank's ability to really be profitable. If the people don't trust the bank's ability to be profitable, slashing interest rates does nothing because you won't borrow money from the bank. So there, the government's overconfidence in the interest rates coupled with the huge amounts of debt that the people bought as the result of the inequality and the political compromises translated into the recession. Now, but there's more to this. The political compromises also prevented people from using tax money to bail out the bank. Now, there's one question here about how banks are typically bailed out. There are many ways of doing it. Like in some instances, the government just pours money into the bank by buying banks' shares or by buying banks' bonds. or by assuming a certain stake inside the bank. And once you assume a certain stake inside the bank, you as the government become liable for a lot of debt that the bank has to pay to other banks. Once you're able to do that, the bank has enough capital with them to be able to service all the savings bank accounts, etc., which the people have. Because if I have a savings bank account and if that bank account is really safe, then I will not go to the bank and pull money out. Because if everybody rushes to the bank simultaneously to pull money out, then the bank is definitely going to crash. So once the people were reassured because the bank had the money which you could pull out, people stopped pulling it out because the money was not going to disappear simply inside the banks. As a result of this, you had huge bailouts, but ideologically, the then Republican government again was against using taxpayer money for bailing out banks. So when the other measures were failing, Lehman Brothers was not bailed out. And the reason given was you're not going to use taxpayer money there. And at that point, the overconfidence that the banks had that the government is going to bail them out anyway is something that broke down. And that's what led to banks losing confidence of other banks and public losing confidence of the banks. And once that happened, the crisis rippled across the entire economy of the United States and the rest of the Europe and in turn some Asian countries as well. So that's where bank bailouts were there. Now, why Yes Bank wasn't bailed out, like I'm not sure about what the details are, but a typical reason why you won't bail out a bank is simply because it costs you a lot of money and that in a way it's the taxpayer who has to bear the losses based on the poor judgment which the banks showed. So to that extent, the banks had shown poor judgment by assuming that government will do certain things because the government indicated that it's going to do those things. However, the government eventually did not bail Lehman Brothers out and that caused the panic. However, the government eventually bailed out the other banks to prevent this panic from growing exponentially. So that is broadly the reason why like the banks were bailed out. Now, why didn't they consider negative interest rates? Because you didn't want a bank run to happen, which means that if there's a negative interest rate over there, people will start pulling their money out of their savings account at that time. So there's no point of lowering the interest rates when you don't trust the banking system altogether. To that extent, interest rates wouldn't have helped because the credit was being lost by the virtue of people losing their faith in the system itself. So unlike the previous crises where there was generally like a demand shock or a supply shock, here the cause was counterparty risk. People did not trust the counterparty that the bank was. And that's how the crisis really started. Or that's broadly why the crisis happened. Now, coming to like the conclusion of this workshop, a lot of problems that existed back then also exist today, which means that even today 97 like a huge amount of money, actually 97% in United Kingdom, but a huge amount of money is still created by the commercial banks. The credits are still unstable, the regulations are still quite lax on the banking system, and the government does have a history of bailouts, etc. So those fractures exist, but at the same time the banks have also learned from this, and as a result the economy did grow for like almost 1 decade unhindered, more than 1 decade in fact, in many countries. So there are some lessons which were learned. Bankers are more careful, less overconfident, and today the government is really smart enough to bail out uh, not just banks but also a lot of businesses during the COVID crisis. Or the reluctance to bail out banks was something which was taken away at a point in time where they already did that in 2008. So people know what happens when you don't bail out a bank. So in a way, 2008 helped the world to deal with the COVID crisis in 2020 because people know what happens when you don't bail out these institutions. So the simple lesson to be learned here is one, be flexible on your policies, look at the situation today, and then decide what are the best policies. So if you think that the inequality today is really stark, then go for a redistributive policy. If you think that the economic growth is really slow, the inflation is really high, the government has become too big and inefficient, then cut down on all of that. If you think the inflation is really high, target the inflation. If you think unemployment is very high, target unemployment. Use the policies that best serve today's circumstances and best serve the people's requirements, and these problems will not arise. Show some degree of pragmatism. Sometimes the left leaning policies are the best suited, sometimes the right leaning policies are the best suited. So be flexible there. And I think people have learned these lessons because Republican Party, the party which is generally pro free market, today, like recently approved one of the largest government handouts in history. So I think people have learned that. So that is there. Uh, Let me see if there are any further questions there. Okay, so I think Parth asked me about how the government should be dealing with the COVID situation. I think I'm running out of time right now. I just have around 10ish minutes, so I'll just discuss that, and then this will just conclude our hour-long workshop. So, in the COVID crisis, the governments have imposed lockdowns, which means that the businesses cannot really transact. Now, when the businesses cannot really transact, you know that the economy is going to shrink. When the economy is going to shrink, people will not be having jobs. If people don't have jobs, they don't have money to buy something. If you don't have money to buy something, corporations cannot sell. And if corporations cannot sell, then it cannot employ people, which in turn translates again to people not being able to buy things. So it's a cycle which is going to become worse over time. Now, what the government should be doing is, I mean, broadly speaking, are three things that they're already trying to do. The first is keep the banking sector stable. As we have seen from 2008, if the financial sector collapses, then there is absolutely nothing that the government can do beyond bailing out banks, because all businesses rely on credit which the commercial banks create for economy to grow. So first thing is to keep the ability to create credit very effective. Second is you make sure that people trust your banking system, which means that you recapitalize your banks, you bail them out if necessary, you nationalize them if you think that that's the best way forward, but make sure that the banking system is more or less stable. The next thing is to make sure that consumption remains stable, which means people keep buying things so that businesses can sell things. So the United States government tries to do it by giving some amount of money to the people at hand. But even in countries like India, where you lack resources, uh, the government has already enacted policies such as allowing people to not pay insurance premiums, etc., for a period of 2 months, because that will reduce the cost that people with insurance have to pay. So either increase your income or decrease your expenditure, but either way, just ease the pain that the people are going through. Third is that try and gradually open up the lockdown as the the COVID curve starts tapering, and impose it back whenever the COVID curve stops tapering and starts increasing, which means that you will see not a V-shaped recovery, but more like a W-shaped recovery. Not even a W, more like waves all over the economy. So you'll have periods of lockdowns, followed by contractions, followed by bailouts, followed by expansions. But keep doing that so that there are interim periods where the economy is still functioning, and you're not breaking the back of the economy by keeping it locked down for a very long period of time. So those are broad ways in which the COVID crisis is something that can be dealt with. Uh, I would elaborate a lot into what can be done right now, but what we should be looking forward to right now with respect to the crisis is a full-blown recession, which should follow uh, any long period of economic expansion, which means that people will borrow a lot lesser because businesses are not very confident that you'll have customers. Customers will spend lesser because they are not very confident what they should be buying, what they shouldn't. Or some customers will probably be unsure about their job, so they'll be busy saving the money that they have. So there'll be this short period of mismatch, but the IMF is predicting a strong economic recovery by 2021, though not as strong as the pre-corona trend. Okay, now, are there any further questions here? If you're too flexible, doesn't that mean you kind of get all the debt and none of the surplus? Yeah. So when you're flexible, what that means is that when the times are good, you tax the businesses, you try and balance your budget, you use all those policies which are slightly more neoliberalish, you allow private sector to flourish, and you reduce public welfare and public support because the economy itself is going to take care of you, which means that the government has sufficient money at their hands in case they need to directly give it to the people on the ground through bailouts. Secondly, during the good times, you also raise the interest rates so that businesses don't arbitrarily make bad investments and take high risks. But at the same time, this makes sure that eventually, when the crisis strikes, you have sufficient room to cut down your interest rates further. So I think these are the ways in which the businesses can be flexible. So you make surpluses during the good times, you run deficits during the bad times, and that's how you play the game. Okay. Do you have any further questions? So yeah, I think some people also ask me what subprime mortgages are. Subprime mortgages are below average mortgages where people are less likely to like buy it. All right. So I'll conclude the session now. If you have any further questions, just feel free to PM me or just put it up on the group. I'll respond either in private or on the WhatsApp group. So first you can just stop the recording.